Zombie malls coming soon to a neighborhood near you. Are interest rates headed higher or lower? And whatever you do, don't miss out on our section on FOMO.
Good evening. It's Wednesday, March 24th, 2021. Do you know where your money is? Thank you for watching Money on the Mooove. My name's Seth Peterson. I'm your host. It was another wild day on Wall Street today. The 10-year yield finished unchanged at 1.61%. The NASDAQ was the big loser of the day, down a little over 2% at 12,961. Price of gas got a little bit cheaper, with the price of oil finishing at $60.40 a barrel. John Paul Getty once said, "If you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problems." For Greensill Capital, it looks like it's going to be Credit Suisse shareholders who end up holding the bag. How did we get here? Well, let's go over the who, what, where, when, and why. Greensill Capital is the classic case of counting your chickens before they hatch. Pipe down, you. Greensill Capital was basically a payday lender of the corporate world. If you were desperate and hard up for cash, you went to them. And then you promised to pay them with the money that you were going to make in the near future. The problem is, they decided to put all their eggs in one basket. And they gave a lot of loans to somebody who had invested in the fund in the first place, raising some pretty clear conflicts of interest. Well, turns out a lot of those loans are bad. Now they gotta figure the whole thing out. But the bottom line is Greensill didn't have the money. So what did they do? They went to the people who were selling their loans and helping them fund their loans at Credit Suisse. Credit Suisse had set up a bunch of funds that they were basically buying this debt into. And when they found out that Greensill Capital needed money, they loaned them their own money while they had their customers invested in their funds. Here's the problem. These funds are supposed to be like money markets. Like, this isn't high yield payday lending. They're not getting the 26% VIG that you get down the block. No, they were paying marginal yields that were just slightly above what anybody else was paying, and most of the people who ended up putting their money into them probably didn't even realize that they were investing in something that was even a little bit aggressive. Anyway, it looks like a lot of towns in Germany ended up getting their money locked up in all of this. It looks like countless investors across the entire US got locked up into this, to the point where Credit Suisse has decided that they may consider spinning off their asset management group to prevent these sorts of conflicts in the future. Maybe it's not a good idea to having the fox guard the henhouse. Is the American consumer going to continue to go to malls once the economy reopens? Or is it time to put the malls out to pasture? Here's a report from Trepwire on some green shoots that they're beginning to see in the commercial real estate sector.
Well, I'll caveat this with 1 month does not a trend make, and we try to talk about that with regard to special servicing numbers and delinquency numbers, that you do see blips every now and then. But I will point out some things that we did start to see in March that were encouraging. It seemed like new additions to special servicing were really slowing this month. It really seemed to trickle trickle away, and it seemed like a lot of loans that had been in special servicing were making their way back to the master servicer. So that was an early trend. And when I say early, I was looking at this data when about half of the loans had remitted and reported. So maybe 250 billion out of a 500 billion set of loans out there. We saw a real diminishing number of borrowers throwing in the towel, right? We had said in the fall and winter that every month we were seeing a dozen or 2 dozen borrowers reach out to the special servicer and say, we're going to send the keys back. We're going to do a stipulated foreclosure. We're not going to contest anything. That whole plan of consensual default, that really trickled off. We saw very few of those in the last 2 months, which is a great thing. And lastly, we're starting to see more valuations come out that are at or above the loan balance. So we've talked about this in the past, that in the mall space, we've seen places where a new valuation comes in at 25% of what it had been at securitization and 50% less than what the balance is of the loan today. Now we're seeing some more positive things. I'll give a couple of examples. The Green Acres Mall, it's a big Nassau County, Long Island mall, has 260 million in debt on it. It was valued at 514 million at securitization, which I think was in 2013. The latest valuation came in at 357 million, which should be the kind of thing that keeps the borrower engaged as we come out of COVID. Another one, the $82 million Marriott Gateway Crystal loan. That's a almost 700 key full service hotel in Arlington, Virginia. The collateral was valued at 162 million in 2010. This month, it was lowered to about 107 million, giving the loan an implied LTV still of 77. So that loan makes up about 2/3 of the remaining collateral behind a 2011 deal. So the point here being, and I'll turn it over to Joe in just a minute to kind of add some color to this, is that these things are not coming in at levels where the borrower, their knee-jerk reaction will be, let's give back the keys. Their knee-jerk reaction when you see valuations like this are, let's see if we can extend the loan, let's see if we can get some rate relief, maybe turn the loan to interest only. But this idea of positive or negative equity is a big driver in things like our default model, right? What percentage of the loans are going to default under baseline and moderately adverse and seriously adverse cases, and the same with the CECL loan reserves, right? These are the kinds of things that Joe has spent a couple of years building out, to kind of indicate what losses will be. And to the extent that these things are coming in higher, that's a good sign that losses may not be as big as maybe we thought about 6 months ago.
Some may be optimistic about the valuations of the commercial malls, but this week was not a good week for Washington Prime Group. This is a real estate investment trust that invests exclusively in malls. They have had one heck of a ride over the last 5 years as they've watched their revenue slide month after month after month after month to the point where they've now defaulted on a $40 million loan. Bloomberg's reported that they're seeking a $150 million loan in order to try to get them through some sort of bankruptcy. But to put this into perspective, they had $111 million in their bank account last December. It's only March 24th, and they don't even have enough money to make their interest payments on their debt, let alone pay back all the debt that's going to come due because they defaulted. This is not looking good for the malls. It's not looking good for Washington Prime Group. It's not looking good for their 750 employees in Ohio who are about to lose their jobs because the REIT is imploding on itself. This is not a situation where there's going to be a white knight that comes in and rescue it. This is a zombie company. This is a company that cannot survive without access to more credit, more debt, without getting deeper and deeper and deeper until it fails. And like real zombies in a real apocalypse, it will drive the neighborhoods around it down. Here's a clip right here about what's happening at one local shopping center in Palm Desert.
We've got a swap meet in the parking lot, and this swap meet started a couple weeks ago. Now it's Friday, Saturday, Sunday. Maybe it'll go 7 days a week. This would have never been tolerated back in the day, swap meets in Palm Desert, but the parking lots are completely empty because all the stores are gone. And so now I guess you can just have a swap meet in these parking lots in Palm Desert. So something I never thought I would ever see in the city of Palm Desert, but here we are. Swap meets popping up, and they started out 2 days a week. Now they're gone to 3 days a week, and I'm sure it's just going to get bigger, and it could go more. It could go more than 3 days a week, and I'm sure that we're going to see more vendors out there and more people out there buying things because everybody's looking for the cheapest possible price. But I see shopping carts everywhere just thrown around in the parking lot now. I see, people that look a little bit questionable. But again, the parking lots are just going to waste because all the stores are gone. So now people are coming in from God knows where and setting up portable stores.
With so much free money floating around out there, it's hard to know what the value of anything really should be. When you take price discovery away from the marketplace, you end up with some pretty unusual results. Here's a dispatch from Dodson Armsov with one indicator that he's noticed locally.
And in the border area of North Carolina, Virginia, and over toward Raleigh, they're littered with aluminum cans. You see a whole lot of scrap steel, wash machines that are dumped. Back before 2008, all the way up to about 2016, this stuff was policed up pretty fast. So this is a two-prong indicator of how deep the economic collapse is getting. So what I did is I looked up the prices for these metals, and it was quite obvious why nobody's picking this stuff up. Right now, aluminum cans are going for 37 cents a pound. Electric motors are going for 17 cents a pound. In this area, a lot of electrical motors, a lot of alternators, which are going for 15 cents a pound, they were always scrapped to get the aluminum and the copper from them. At only 17 cents a pound, nobody's going to bother with that. Then when you look at high-grade steels, they're only given $178 per ton. So a two-pronged approach here to the economic collapse. Number one, the scrapping methodologies many people use to get through the 2008 recession, depression, cannot be used today to help supplement income. There's no real high demand for aluminum, copper, and steel in our manufacturing industries. Everything's shut down. There's no demand for anything because half the country's unemployed. And around the world, unemployment is so high, nobody's buying stuff. They're not even buying the raw material from us. So what we're noticing today is the fact that nobody is scrapping any of the materials they scrapped back in 2008 to survive on. So the demand for metals is so low on the manufacturing front that the prices people are getting for scrap aluminum, copper, and steel is not worth the time for them to go get it and haul it to the scrapper.
The change in interest rate on the 10-year yield is starting to spill over into the mortgage market, making it harder for borrowers to pay as much for the housing prices. Here's a report from Javier Vidana on the local market in Arizona.
So agents have been seriously marketing towards these sellers, homeowners, having conversations with them. And I think we're getting to that 3-month period now where sellers are like, yeah, it's a great time to sell. my neighbor sold their house and made this much for it. Holy crap, I want to make that much for it. I think there's starting to become more sellers that are just throwing caution to the wind and saying, we'll go rent, we'll go live somewhere else, because once again, FOMO, I want to get rid of this house at top dollar now before it drops in value. And I know this not just because I'm guessing. I actually had conversations with real estate photographers, and they're getting booked. They're getting booked in weeks in advance now. They're seeing a huge demand of, holy crap, there's a lot of photos that want to be taken. And here, just so you guys know, in the cities, the major cities, there's like 3 or 4 companies that are like the standard that most everybody uses. Now, they're not the best all the time, but they're the ones that are easy to use. You order online, it's like $120 and you get professional photos taken, and your seller thinks you're amazing, but really you just paid $100. These are the companies that 80% of realtors use, and those are the ones that I had conversations with that are saying, you know what, yes, we're getting booked in advance. There's a huge rush of listings coming in soon. You're going to start slowly seeing that decrease of demand from buyers. It's not going to be a massive drop. There's still a lot of people that want to buy homes, but you're going to slowly start seeing that decrease. Those rising interest rates hurt. I'm buying a second home right now, and I almost got caught in a 4.5 interest rate, because the second home and interest rates just like skyrocketed last week. So thankfully my lender locked me in early enough where I'm still in the low 3s, but I almost freaking got stuck at 4.5. I think a lender told me that there are like 10, 15 cancellations of second home purchases last week just because of that, right? It's going to slowly be a trickle, or that demand.
Javier, you should think about not going through with that second home purchase if everybody else is pulling out at the same time too. Hey, food for thought, right?
And starts steadily dropping. Like right now, we're at 9,500 closings per month here in Phoenix. Now the next month might seem normal because the next month's numbers are this month's numbers, but the month following is going to be probably 8 or 7 in my opinion. Now, you would combine this with the inventory that's going to start rising soon. Now, once again, this is just a prediction, but if my sources are correct and my rule of 3 months is true, you're going to start seeing a nice little flow of listings. Now, if it's going to be a massive rush, I really doubt it. Maybe about 20 to 30% increase of inventory out there. So like, for example, we have 5,000 listings in Phoenix right now. We might see another 1,000 hit the market. So we might be floating around 5,000 to 6,000 in 2 to 3 months. By quarter 2, you're going to start seeing the changes slowly happen. Quarter 3, you'll feel the effects of it quarter 3, and definitely quarter 4, where historically it's always been a slower time to sell or buy. You're going to start really feeling it there. So I don't think it's necessarily going to be a market crash, but I do think it's going to provide that nice little flow of cushion for home buyers who are struggling right now. Now, here's the problem with this. Even though it will be less competitive to buy, it's still going to be more expensive. The effects of this increase of values are going to be remaining for a bit. So what I mean by that is, even though things start stabilizing and things aren't selling at a rapid rate, those prices are still going to be higher. So unfortunately, there are many cities that are just going to be a little more expensive to live in. So what this might cause is more of an exodus, not necessarily from California and New York. Their exodus has already happened. But what I also predict is a small exodus of the people who lived in these towns who are no longer able to buy, going to smaller towns or going to towns that are not so known. So that might be happening, and your smaller towns actually might be seeing a little boost in value because of that.
No doubt about it. Higher interest rates mean lower home prices for the American consumer. But not everybody agrees that interest rates are going higher. Here's a report from Economic Ninja, where he argues that he sees rates being forced to go lower.
I am expecting the 10-year to continue to have upward pressure, and I believe that it is going to force the Federal Reserve to drop interest rates, the prime rate, the Federal Reserve prime rate, into negative territory. Now, for a couple reasons. First off, the bonds are actually moving up because people are feeling less confident about the economy. They want more rate of return, like a higher rate of return for their loan. So when they loan money and in the form of bonds, they want a higher rate of return. So that's putting upward pressure. Well, since that upward pressure is causing the housing market to slow down or possibly stall, the Federal Reserve is going to be forced to drop rates negative. Now, when that happens, that will also drop rates for refinances on homes and new home purchases. Now, just so you know, if they drop the rate by 1%, that doesn't always correlate perfectly with a mortgage, okay? So just because the Fed lowers rates 1%, it doesn't mean that home mortgages are going to drop 1%. But what that does mean is that it will cause another spike in inflation when it comes to home prices. And that is because people look at that lower payment and they can't help themselves but go out and borrow more money. They're greedy. And they don't understand that that is actually the sign of a collapse. So healthy markets do not have low rates. They especially do not have negative rates. That's a sign that we are doing very poorly in the economy. Okay?
Wow, negative rates would do terrible things to the stable value funds, to the money market funds, to the very funds that Greensill was exposing the market to. What's going to happen if we go into negative interest rates and people tell you that you start to have to pay to have the privilege of keeping your money at the bank? People are going to withdraw their money so fast there won't be any left. Thank you for tuning in to tonight's episode of Money on the Move. Remember, pigs get fed, hogs get slaughtered. Cautious investing to all.